if you're a global bond investor, the United States looks a little bit like 5 or 10% more like an emerging market country, not like the United States of America. And this is bipartisan. They are smoking in the dynamite shed in Washington. Global allocators of big bond buyers are just shocked, and they're coming up with a portfolio right now. They want to own more Aussie dollars. They want to own the Korean won. They want to own some Bitcoin. They want to own some platinum, palladium, gold, silver. They're owning an entire basket of assets that are not really dollar exposed because they have to get down dollar exposure. A really nasty default cycle is coming. And question is it mid 26, late 26? I think the Trump team has the midterms. They want to do whatever they can to get through the midterms and avoid this. To your point, your question, is this a cyclical or is it secular? This is a secular bear market for the dollar. You'll have rallies, but the dollar is heading, much, much lower over the next, 5 years.
Welcome, everybody. I'm very pleased to have with us Larry McDonald. Larry is a New York Times best-selling author and the founder of a must-read investment macro trends newsletter, The Bear Traps Report. He's a former Wall Street executive and a frequent writer for Bloomberg, Forbes, and CNBC. Larry has written a fascinating new book titled How to Listen When Markets Speak. Our viewers will find it linked in the video description below. I will have to pick up a copy to read soon as well. Larry, I've seen your commentary on major news outlets, and it's been, so many times when I saw your commentary and I thought, oh my God, I have to speak to him. I'm so excited to connect with you. Thank you so much for joining. Welcome.
Thank you, Lena. And the words I live by is, there's no I in team. And my first book came out 2009. It was a New York Times bestseller about Lehman Brothers, the big bank. And we did 140 speeches in 16 countries over the last 16 years or so. And we met so many talented portfolio managers, chief investment officers that are in our Bloomberg chat today. So we run the Bloomberg chat, the Discord chat with some of the brightest CIOs, hedge funds, mutual funds, pension funds. And what we try to do in the book and what I want to do in the show is most important thing is democratize information and help a more broad audience understand what the big boys are up to, what the big boys and girls are up to.
Absolutely. And I think this is an incredible opportunity to learn from you and also to understand what's going on right now. There's certainly a lot going on, and I know many people are confused. So, Larry, I've got to ask you this. During the 2008 financial crisis, you were at the very center of the events. You were a special advisor to the Financial Crisis Inquiry Commission that was created by Congress to investigate the causes, both domestic and global, of the 2008 financial crisis. And as you just mentioned, you wrote an entire book with your account of the financial crash. Are you seeing similar red flags in our economy now? Are there any parallels that may be drawn between what you saw leading up to the 2008 financial crash and during it, and what you see now? Can you talk about that just a bit?
Well, so the key, yes, the key is to build great mentors. And so in the book, David Einhorn, we sit down with David Tepper, Charlie Munger. But in the chat, we've got these great mentors, and a lot of them don't know each other. And what I find fascinating, Lena, is when three or four or five or maybe six people say the same thing to me roughly in the same week, and they're in three or four different continents, and they're, maybe one of them's in what we call high yield or junk bonds. The other one might be a rates trader, so they're trading treasuries or FX, foreign exchange. And when three people or four say the same thing in the same 10, 15, 20-day period, it really makes the hair on the back of my neck go up a little bit. And in the last month, I've had three different people told me they bought my previous book and gave it to traders on the desk. And I haven't heard this in ages. And because they're seeing a lot of the same things in subprime, in student loans, some of the things that the Trump team is doing, at the end of the day, when you go from a very progressive administration to a conservative one, so Biden into Trump, the unintended consequences of that are jaw-dropping. And I think when you try to like take all these student loans and you're basically all these people had kind of like a very, very easy gravy train on the credit score situation. And now we're going to move all those people back very fast. And the unintended consequences of that are pretty startling. And you could see it in the buy now, pay later names, right? The Affirms, the Upstarts, and the tertiary lenders, your Synchronies, your Credit Acceptance. The underperformance is very dramatic versus the big financials. So the bottom line is yes, we are seeing a rising trend in kind of subprime credit risk. It's not as bad as 2008 yet, but it's the same type of things that we saw in 2007.
I'd love to get your thoughts on the very alarming developments in the bond market. A recent auction for US Treasury bonds saw quite weak demand, and it led to rising yields and investor concerns, quite understandably. And of course, the concerns focused on the nation's debt. The auction sold the bonds at a rate over 5%, which of course is the highest since 2020. And the 10-year yield also spiked. So the weak demand, along with other factors like concerns about geopolitical risks, we have several conflicts going on at once with no end in sight. And so those contributed to a sell-off, what appears to be in treasury bonds, and a general uncertainty in the bond market. And so, how concerned are you about the $29 trillion US Treasury market? Is it actually running out of buyers? What is your take on what the latest events mean?
Okay, so if you're a global bond buyer, in the last 6 months, think of what you've been through. In the first quarter of this fiscal year, 25, which was October to December, this fiscal year, the Biden team jacked up essentially a $1 trillion deficit spending, a little bit under that, but in just 3 months. So you're running a pension fund in Europe, and you just saw that. Then Trump comes into the Rose Garden, uh, I guess in early April, and hit the global investment community over the head with a big tax increase through tariffs. And then he walked it back and forth. And then he's in the Oval Office with Elon promising a balanced budget. And then a month later, he's essentially sitting down with the Freedom Caucus, which is the most conservative fiscal group in the House. And he's basically trying to force feed them a big, like anti-Doge budget, right? Like the complete
Mhm.
opposite of Doge. And then Elon Musk leaves the White House, in this week or so. So if you're a global bond investor, the United States looks a little bit like 5 or 10% more like an emerging market country, not like the United States of America. And this is bipartisan. They are smoking in the dynamite shed in Washington. What they are doing in the Congress, and this, remember, it's not Democrats, it's Democrats and Republicans. What Kevin McCarthy did a year and a half, 2 years ago on the debt ceiling was embarrassing. It allowed Biden to juice spending. And just think, we had a big fiscal expansion in that deficit spending in the fourth, and I guess in the first quarter, and then we had 100 basis points of rate cuts, okay, from the Fed, and now we have another potential $1 trillion of capex coming into artificial intelligence.
Mhm.
This is a potentially deadly cocktail for inflation. Unintended consequences are piling up, and our congressmen in our Senate and in the House, they're just smoking the dynamite shed, and they're not going to learn their lesson until the bond market slaps them upside the head, and that's probably going to happen later this year.
If you had to pinpoint the causes or the main drivers of the sell-off in treasury bonds in May, What would those be?
Well, there was a day around the 7th or 8th of April, and I did a video on X, and it got 1 million views. And what I talked about in the video was that what Trump team has some different people in there. Howard Lutnick did not really think through, I thought, according to my clients, it wasn't very well thought through. And the formula that they used was probably not the best formula. And we were sitting down with at a hedge fund dinner in New York, and I had European allocators there. We had Canadian allocators, people that position billions and billions of dollars in bonds. And two or three of them said they basically are going to get fired unless they take down their dollar exposure. Because to make it simple for the audience, the United States of America, if you look back the last 50 years, there aren't many days where stocks are down, bonds are down, and the dollar's down on the same day, right? And we've had a lot of those types of days since April, since the Rose Garden. And if you're a global allocator, if you're a global bond investor, you've had this 30, 40-year period of real hardcore confidence in the United States. That confidence now has been shaken. And the most important thing in the book that we talk about, and we talk about the dollar and stress, and I want to make it very clear, we're not saying that the United States is going to lose its reserve currency status, not in my lifetime. But what we're saying is going into this year, the planet Earth was two standard deviations, long dollars, long financial assets. What we talk, so there's financial assets and hard assets. Everybody was table max long dollars, what we call two standard deviations more than the 30-year mean. And what's happening is global allocators are being forced to take down dollar exposure because of Biden, because of Trump, and that's going to go back to that 30-year mean. Right now, they're way up above it. And that gets back to why the auctions are starting. If you look at the deterioration in the auctions the last year relative to previous years, yeah, there's a massive deterioration.
It seems that the global instability is now a new norm. As you pointed out, there's many things going on, and none of them seem to be very promising. Our viewers might want to hear from you about the recent Japan's bond auction. I know that it's also hitting very weak demand. What does it mean for US Treasury yields and for the global economic outlook?
Okay, so let's go back to the global pension fund. Yeah, this is not just a US thing. We've had global rates going. So for decades, Japan was what we call the global yield anchor, right? And we've had inflation, we've had bad fiscal policy in the United States and in Japan. And this is the most important part of this sit down is you have to think of the psychology of a bond investor. And the reason why that's important for people watching us right now is bonds impact your mortgage, impact your car loan. And so we got to remember what happens in the bond market is really important. And for the last 30 years, going into the last couple of years, but the last 30 years, 99% of the time, if there was any type of crisis in the world, whether it be Brexit or Lehman, your bonds on the long-term bonds might have made 10, 20, 30% because as interest rates go down, bond prices go up. It's really simple. So if you have say a 4% bond and interest rates go to 1%, that 4% bond for 10 years is now worth a lot more than 100 that you paid for it. So when interest rates go down, bond prices go up. And for a long time, investors around the world had the luxury of like, okay, the stock market's crashing. At Lehman, we lost 7 trillion, $7 trillion on stocks, and we made back 3 trillion on bonds. And during COVID, we lost close to 9 trillion on stocks. We made back 4 trillion on bonds. So that's been the case over and over again. Bonds have bailed out the stock market. What's happened since 2022, Lena, is really blood curdling because it keeps happening. So if you think of the big drawdown since 2022 in the stock market, we had like a 30% drawdown there or so, 25, 30, and 22. We had a drawdown in August of this past year. It wasn't that bad, but it was pretty interesting. And then we had a drawdown, a pretty substantial drawdown in the last since from I guess from February to April. In all three of those since 2022, the long end, the long-term 30-year bonds, your 10s, 30s, 20s, and in Japan and the United States basically didn't make you any money, right? So what global investors are saying is that why should I hold? And this is part of the decay in confidence. Why should I hold a 30-year bond if I'm not getting that kind of like traditional protection from recession risk or from the stock market going down? Since 2022, investors around the world have been losing money on stocks and actually losing money on bonds at the same time. And if you look around the world, that's the thing, Lena. That's the thing that typically happens into emerging market countries. So at the end of the day, the bottom line is the point we make in our book. The guys that are smoking in the dynamite shite in Washington have created a dynamic where the US has become like 5 or 10% more like like a Brazil. And our markets are starting to act when stocks go down, bonds go down, the dollar goes down all in the same day or week. That is shocking to the core. Your global allocators of big bond buyers are just shocked. And they're coming up with a portfolio right now. They want to own more Aussie dollars. They want to own the Korean won. They want to own some Bitcoin. They want to own some platinum, palladium, gold, silver. They're owning an entire basket of assets that are not really dollar exposed because they have to get down dollar exposure.
This is so fascinating, and we certainly see shifts in so many different areas. Like you mentioned, it's not just finance and economics, but also geopolitics, and here domestically, so many things are happening all at once, and it creates that volatility and uncertainty that then translates into these moves, these transactions that you just mentioned. One of the catalysts of this global volatility was President Trump's what is it? Liberation Day, right? The tariffs. And yesterday it was announced that President Trump's global tariffs were actually deemed illegal and blocked by the US Trade Court. How do you expect the court decision to affect the markets?
Well, if you think about it, right, what Trump's been promising, Trump team has been bragging about the tax revenue from tariffs. Now, some people argue that that's a tax on U.S. consumers, and some people argue it's a tax on China. But the bottom line is anything that stops those tax revenues, at least the future path of them, is going to really impact the bond market. So just think about the bond market. You've had this really weak year where these bonds have sold off. We're up to 30% on the 30 year. I'm sorry, we're up to 5% on the 30 year. Excuse me. So we're up to 5% on the 30-year treasury, and we have all this tax revenue coming in from tariffs. Now, if that tax revenue is at risk because of the courts, then you're going to see some pretty nasty unintended consequences there in the bond market for sure. So that's the first thing I would say is that the market needs and the Trump budget that was passed by the House, but it's the House bill has to be merged with the Senate bill, and this is really coming down the pike this year. But at the end of the day, that we need that tax revenue for what they're trying to put forth in the budget. And it's going to freak out the bond market if we don't have that tax revenue.
Maybe we could switch gears a bit and talk about the US economy. in greater detail. So the first quarter GDP came in negative. Household delinquencies have been rising, especially that 90 days plus category, which is a major red flag. And the US credit rating has been downgraded. Moody's, of course, cited surging federal debt as an indicator of fiscal concerns moving forward. In a recent interview that I really enjoyed, you mentioned that it is important to raise cash in the current economic environment. Could you elaborate on that and help us understand why that is the case?
Well, since 2021, the only thing that's really worked is when the probability of a hard landing goes down dramatically. If you raise cash, that's been the right thing to do because we've had th two or three instances now since 21 where the probability of a hard landing goes up a lot. And there's a theory that if they don't get interest rates down, then it's gonna right now interest is $1 trillion per year. It's greater than defense spending. In interest as a percentage of tax receipts is like near 20%, which is in a very, very wacky, lunatic danger zone. The rest of the world is nowhere near that. And so a lot of clients think that we need to get rates down, and that's why Powell cut rates 100 basis points, even though the economy, all the GDP indicators back then were actually very, very healthy, and we were cutting rates 100 basis points. So the point of our book, How to Listen When Markets Speak, comes down to financial repression. The only way you can get out of a 36, $38 trillion debt hole without default is to get interest rates below the rate of inflation. Get interest rates below the rate of inflation, and then you can inflate your way up. The problem is if you go into recession and tax receipts fall, then you're in real trouble because then your interest as a percentage of tax receipts starts to really overwhelm the government, and that's when the Fed has to step in and really move into quantitative easing or yield curve control. That would really weaken the dollar, and that would really put you into a massive bull market for commodities and hard assets. So in some ways, they need to slow the economy down, so then cut rates more. And that's what you kind of saw in that January, February, March area. But they can't let it slow down too much. And that's why if you look at the budget, um, relative to what we were told about all these budget cuts, they're just terrified. And that's why the spending in the budget is still really in the Biden territory. And as long as the budgets are that big, it's very difficult to go into recession.
In a recent post on X, you mentioned Fed Chair Jerome Powell's now notorious statement that he made about a year ago. He said that he sees neither a stag nor inflation. And now, when we fast forward a year later, 12 months later, Fed President Neil Kashkari says the question now is the magnitude of stagflation, not whether it will happen, but it's actually how bad is it going to get. So are we truly too far along for things to improve? In other words, how bad do you expect the economic situation here in the United States to get before we see any improvements?
Well, yeah, so the last several years, we've had um, a deterioration where we're going to a regime of higher bond yields, higher inflation, and every time the economy softened, like say the regional bank crisis of 2023, the Fed opened up this incredible facility around basically supporting the bond market. They expanded the balance sheet. They just cut rates 100 basis points. So they've been doing all of these really what we call dovish things that are very, very supportive to keep us out of recession. And it's like they won't take the medicine. The only way you really truly kill inflation, we make a point in the book that I sat down with Andre Estevez in Brazil, and he's the CEO of BTG Pactual. billionaire, probably one of the top investors in all of Latin America. Brilliant man. He's like, Larry, Americans don't understand. Once inflation gets above 6% and is there for at least a year, it's under the seat cushions. It's in the carpets. And they'll knock it down, but everything they do in Washington, unless they really try to kill it with real budget cuts and real lots of rate hikes that stay up there, they're not going to kill it, and it just keeps coming back. It's like it's like a scene from the Terminator. You know, the Terminator keeps
Right.
coming up, keep coming back. Arnold Schwarzenegger. And that's what's been happening since 23. Every time they knock it down a little bit, comes back up. Yeah, so the probability that we're moving into a 1968 to 1980 regime of stagflation, higher interest rates, higher bond yields, elevated inflation, and then some softness in the economy at the same time. That's real stagflation. And the one thing central bankers always remember, central bankers are like the pilot on the airplane when they're losing an engine. All they're going to say is, ladies and gentlemen, stay in your seats, everything's fine. They don't want to panic. And central bankers will never tell you the truth. In 2007, 8, Bernanke said subprime was contained. And it was like 9 months later, we were in the middle of the worst subprime crisis. And so you're going to be very careful. Yeah, so there's a big deterioration, a big movement towards stagflation. Powell's been in denial of this, and now you've got Fed governors admitting it, like you just said. And so that's why investors watching us right now need a totally different portfolio construction than the previous decade.
Do you believe that this might be a beginning of a full-blown default cycle as well, if this is sort of the environment that we're in or we're moving towards?
Well, yes, if you look at the commercial real estate market and you look at the high yield bond market and the investment grade bond market, the good news is a lot of companies were able to refinance debt in 2020, 21 after COVID. And remember, the Fed suppressed the cost of capital. And they did something amazing. The longer that you suppress the cost of capital and don't allow the business cycle to function, the more kind of evil that's under the surface.
Mhm.
And they created all these distortions by holding interest rates really low. It allowed a lot of companies to finance themselves at like 1.5, like 1.75, 2.25. Apple issued a bond. Let me give you an example. Apple issued a 2.55% coupon bond that matures in 2060. So it pays 2.55%. It matures in 2060. Take a guess that then they issued the bond at par at 100. Take a guess where the bond is now. I'll give you a hint. It's in the 50s. So this is a bond that's backed by Apple. It
Right.
was issued at 100. But when the Fed was suppressing rates, right? And the bonds trading down in the 50s. So imagine all the banks own these bonds that were issued with very, very low coupons. And those bonds are trading in the 50, like 55 cents on the dollar, 53
That's an
cents.
incredible discount, right?
Yeah, incredible. And so now we have these bonds. A lot of the bonds are going to start maturing now. That bond's 2060. That's not maturing. But in the high yield market and in the investment grade market, and especially in commercial real estate, all of this stuff, all those loans that they issued in 2020, 21 are starting to mature. And that's what's going to cause this pretty nasty default cycle. Because imagine if you're a company and the last 4 years or 3 years, Powell's been telling you that we're going to get rates down, and the Wall Street, just look at Wall Street. Wall Street told us by now Fed funds rate should have been back down at 2%. We're still up near 4.5. And and so when those bonds mature, those company financing is going to go up a lot in terms of the cost of capital. And yeah, a really nasty default cycle is coming. And question is it mid 26, late 26? I think the Trump team has the midterms. They want to do whatever they can to get through the midterms and avoid this.
This is truly scary, and I know that some economists now anticipate another round of QE and rate cuts, and you just sort of alluded to it a minute ago. Do you feel the Fed will be forced to cut rates as the economy weakens further, and there is this looming possibility of defaults, as you just described?
Yeah, so think of like the US consumer, the households,
Mhm,
think corporations, think of the mortgage market. Um, a lot of mortgages are that were issued in 2020 at two very low rates are also going to start maturing. And those are going to go up a lot. So the cost for housing, the cost for corporations, because now the cost of capital is in a much higher place because of sustained inflation. We're in a multipolar world. We've got, wars are very inflationary, right? Neil Ferguson in our book talks about wars. Like, think of the Ukraine rebuild, right?
mhm,
It's Think of the Ukraine rebuild. If you just do a Google or Chat GPT search on how many structures have to be rebuilt, think of the LA rebuild, Los Angeles, right? Think of the US power grid. It's 50 years old in some place, 30 years old in others. We're going to put all this artificial intelligence data centers on this. So we have so many sustained inflation forces that are going to keep rates up. And that those higher rates are going to create a lot of pressure on households, on corporations, a big default cycle. The bottom 60% of consumers are already in extreme pain. The top 40% are doing much better, but you can just look across different companies. And that's why those buy now, pay later companies, Klarna admitted a big spike in what we call that subprime lender. And so we're seeing a lot of weakness there. So the Fed will be forced to try to like support this and get rates down.
mhm.
That gets you a weaker dollar. And that's why we're going to see what we call for in the book is there's going to be a multi-trillion dollar migration from financial assets, which are paper certificates, stocks and bonds. That's all they are. It's financial assets over to hard assets. And that's it's not just gold and silver, but it's natural gas companies, oil companies are trading really cheap right now. Companies like Rio Tinto, BHP, companies that own assets in the ground. Your copper companies, we think your copper names, your COPX ETF, your Tech Resources, your Freeports, we think these stocks are all potentially 200 up next 3, 4, 5 years are up 300% because we just are going to have that migration. Let me give you an example to make it simple. When we reached 1980, 81, 49% of the S&P 500 composition after that inflation higher interest rate regime, 49% of the S&P 500's composition was materials, oil and gas, and industrials. 49%. In recent years, when we went through this nasty, disinflation cycle, by 2021 or so, those groups got down to uh, about 12% of the S&P 500's composition. 12%. So when you're in a disinflationary regime, everybody wants to be long financial assets, stocks and bonds and growth stocks. When you move toward more sustained inflation regime, your portfolio construction has to be much more focused on companies that own assets that are going to protect you from that sustained inflation, higher bond yields. And so we think that the portfolio of the composition of the S&P 500 is going to go back not to 49% for materials, industrials, and oil and gas, but you're going to go back to like 30% of the S&P 500 is going to be your Rio Tintos, your Newmonts, your Barrick's now mainly a copper gold company. And that's what we're seeing. That's what we're seeing the smart money is rotating out of financial assets, out of kind of that deflationary portfolio over toward a hard asset inflationary portfolio.
Absolutely incredible. And this is, of course, something that you discussed in your newsletter, which I will link for our viewers in the description below. Um, Larry, if you had to, I know this might be a very tricky question, but if you had to point out maybe one part of the US economy that worries you the most right now, what would that be? What should we be paying very, very close attention to right now?
Well, one thing is passive investing. The baby boomers are turning, they have 79 trillion of wealth, and they're turning 79 years old. And there's a lot of money that's in what we call passive index funds. And all that means is everybody's 401k has been shoehorned into the same stocks, Nvidia, Apple, Microsoft, and so much wealth has been shoehorned in there because of passive investing. And the weird thing about it is, so think of passive versus active. And all that means is your passive is your indexes
Mhm.
and the indexes own stocks. Your active funds are managed by a person or a team, and they buy and sell stocks across different sectors, and they can buy whatever they want, right? They can buy and sell whatever they want. With passive, the bigger passive gets, the more evil it becomes. It started off with Jack Bogle and with great intentions, wonderful intentions. But what I'm hearing from like the smart real institutional investors that when think of passive versus active, if you're 50-50, once you go to 51, 52, 53, 54%, passive versus active, the problem with that is it forces stock prices to crazy levels because the passive funds aren't going to sell, right? So the stock market's going to go up. Vanguard, State Street, they own these stocks. They're passive. They're just going to sit back. There's no sellers, right? And then the companies are doing buybacks. And so once passive gets up near 56, 57%, it becomes really evil. And just look at Microsoft. Look at Microsoft's price to sales is like 13%, which for the last 20 years, Microsoft averaged like 3 to 5 to maybe 6 times sales. Now it's doubled that.
Mhm.
Look at Walmart. I mean, Walmart's trading for almost 40 times earnings. It's because of this passive garbage. And nobody's on the conference calls. I sat down with David Tepper, and I sat down with David Einhorn in the book. David Einhorn is like one of the most famous, legendary investors, great performance over the years. He crushed it every time the market's been down, like 2020, I think 22, 23, he was up 30%. His point is there's so much money in passive that nobody's on the conference calls, nobody's asking the difficult questions, and the market's getting dumber and dumber and dumber. And so that's probably my biggest concern because I know that the when interest rates go up now and the boomers are turning 79, it reminds me of 87 where if rates go to 5.5, 6%, remember the rule of 72, Lena. The rule is 72. If you can get 6%, your money's going to double in 12 years. That's tax deferred. That's the rule of 72. So once the risk-free rate treasuries goes to 6%, someone can buy that and double their money in 12 years. That's an equity-like return, Lena. And that's going to suck money out of the stock market. And so that's what happened in the 87 crash. As rates went up, and we crossed the Rubicon, and billions and billions, just water, a whitewater river of capital moved from stocks over to bonds, and the market crashed. With so much dumb money in the passive side now that's not really paying attention, and rates go up, you could very quickly have this colossal rotation that would create a 1987 type crash sometime in the next year.
This is absolutely fascinating, and thank you for providing such valuable insights. And I certainly hope to um, invite you back on again to discuss this further because I think our viewers and many of my subscribers do ask for advice. And I think this is where this is truly it creates value for them discussing this in such detail and sort of providing guidance. One of the things that I run into very often is the question about the US dollar. And you've briefly alluded to it. I know you discussed this in your book. One of the things that I'd love to get your thoughts on is the fact that the US dollar appears to be losing value compared to a basket of currencies. And if I'm not mistaken, it lost close to 6% since January, since Trump took office. What do you believe is driving this decline in value? I know confidence, you've mentioned confidence is one thing, but do you anticipate this to be more of a long-term trend, or do you see this as a temporary sort of temporary trend until there is a change in US policy or until there is perhaps another event that reverses the course of the value of the US dollar compared to other currencies?
Well, my favorite word in the English language from the first book about the Lehman crash was hubris. Hubris is, if you think of the Lehman management team,
Mhm.
the hubris level of the Lehman Brothers management team, this was a $750 billion bankruptcy. And what the way they were managing the company, the board was under the basically the back pocket of the CEO, and there was just so much hubris, and that just means like really ignorant confidence. And it's the same thing now in Washington. So we've at the hubris level of just spending and not taking things seriously around actually financing our debt. And what's going to happen is the global investment community was very uncomfortable with what Biden did, jacking up an extra 3 trillion of spending in the last couple of years. And that's 3 trillion of deficits. And now Trump, with his erratic behavior on tariffs, that's basically taking the global investment community that was massively overdosing on dollars and taking it down. That's the kind of the first thing. The second thing is there's a lot of people that believe that Trump and JD Vance, and if you watch JD, if you read JD Vance's book, I mean, in our book, we visited families in the Rust Belt, and the United States has been hollowed out. It's devastation after devastation after devastation, ghost town after ghost town after ghost town. I sat down with families. The father, used to work in the auto plant, and his dad making, almost 180,000 a year, and now he's driving for Uber Eats, or he's going to the library pretending he's working. And it's so sad. Life expectancy in the Midwest is crashed because people are just, massive, massive depression in some areas around, getting back to the labor force or in a different way, and unfortunately a downgrade. And so I think deep down the Trump team knows that China manipulated the yuan viciously. We talk about in the book, and we lay it out beautifully in the book, How to Listen to Markets Speak. But what they've done on the yuan and a lot of different trading partners around the world, they're not just cheating on trade, they're cheating on the currency. And I think deep down, the Trump team wants a weaker dollar that will allow our companies to become more competitive with exports. It may help reshore some jobs. I'm not saying that we're not going to make Nike shoes in America, right? But can 5, 10, 20% of the jobs, we've lost 5 million jobs, uh, literally the last like 30 years. We've raised the standard of living globally. If you work at a call center in India, you're making 10 times more than your great grandparents. And so we've raised the standard of living globally. The problem is we're creating a lot more carbon consumers, right? So if you're in India, you've got a moped now, and the first thing that you want is air conditioning. So we're raising that standard of living globally. We're creating more carbon consumers. But in the United States, we've lost 5 million jobs. And so that whole thing has to be rebalanced, probably by 10 or 20%. So if we bring 10% of the jobs back, that's 50,000 jobs, right? So we lost 5 million. So, so I'm sorry, that'd be 500,000 jobs, excuse me. So we lost 5 million jobs, bring 10% back, that's 500,000 jobs. And so that's what Trump's trying to do with the weaker currency. And when you talk to global investors, they know that's kind of the game plan. And so to your point, your question, is this a cyclical or is it secular? This is a secular bear market for the dollar. The dollar, you'll have rallies, but the dollar is heading, much, much lower over the next, 5 years.
You've alluded to the role of national debt and of course government spending. And the United States is now paying more, close to $1 trillion a year just to service that debt. And it's more than it spends on defense. And you've mentioned that interest payments represent the third highest budget item behind Social Security and Medicare. So global investors are looking at this and they're probably thinking, okay, how much longer can this continue? Because the debt ceiling has been suspended until 2025, I believe, right? So there's going to be that discussion happening as well. And it's just as Thomas Massey, representative from Kentucky, says it. He says it's just a sort of kicking the can down the road. So how much longer can we continue this debt and spending cycle before it is too late and it's become too much and global investors lose the confidence that they currently have, that sort of decreasing confidence, but still there's some left, right? Um, how much longer can this continue before the government truly has to face this issue?
Okay, so right now we hit the debt ceiling, I think in January, second, third week in January. And what that means is if $1 billion of bonds matures, they can issue $1 billion. So there's been no new debt issuance for January to February, March, April, May, June, July, by August. By August, they're going to merge the two bills from the House bill and the Senate bill, and we're going to have a reconciliation deal. At that point, the fun starts and the drama starts because what Scott Bessent, the United States Treasury Secretary, is going to have to do is he's going to have to refill the Treasury's checking account, which has been drained down big time. So you think of the United States Treasury, right now we're using all the extraordinary measures. All of June, we're going to be using extraordinary measures. And that's a complicated term. It just means pushing out payments and say military, all kinds of payments get pushed out or the massaging the data, and so they're draining the checking account. And so when they raise the debt ceiling in August from September to the end of the year, we calculate it's almost $600 billion of additional bond issuance, 600 billion more than last year. And this is where the hubris and all the clowns smoking in the dynamite shed in Washington, the bond market's going to body slam these people. And Bissett is trying to come up with a lot of tricks around the SLRs, supplemental leverage ratio. He's going to try to force the banks to own more treasuries, a bunch of tricks. But close to 600 billion bucks is going to have to be sold above and beyond last year. And China's buying less treasuries. They're going to try to force the Japanese and trade deals to buy more treasuries. The bottom line is they do have some tricks up their sleeve, but this is all going to come to a head. And we have what's called the Liz Truss moment. And all that means is in the UK, we had this famous showdown, I think at the end of 2022, where they really just couldn't raise the funds at the market price and bond yields blew out. And the beast in the market slammed the UK, the Bank of England was absolutely body slammed by the bond market. They were forced back into QE buying bonds when they told the world 2 weeks before they were going to be. It was one of the most embarrassing things you've ever seen in the history of finance. Yeah, where politicians and central bankers get body slammed by the bond market. And the same thing is about to happen September, October. you look at the volatility curve, there's a the market's pricing in a big vol event around that time when they have to refill that treasury checking account.
As you mentioned, the economy is very volatile and it's fueled by so many factors: domestic politics, global affairs, geopolitics, so many threats and so many risks. And you've touched upon so many of them during the conversation. However, with risk comes opportunity, right? And so, what is your recommendation for our viewers in terms of ways to safeguard assets and to find sectors to invest in? I know you discussed this probably at great length on a regular basis in the in your report, in your newsletter, but if you had to sort of point our viewers in the right direction, what would you tell them?
Yeah, and remember, I'm a hardworking person that because of the books and because of making deposits around the world, right? The key to success in life is making those deposits, building trust. And what we've done is we've built the trust of some incredible investors. And what I'm seeing a trend shift where just look at energy. Um, Look at artificial intelligence. Let me give you an example. So Wall Street strategists, and I should say research people, they have convinced the retail investor that the way to play artificial intelligence is essentially through semiconductor companies like NVIDIA and like the rest of them. And there's right now, I think if you look at the value of the SOXS, so the SOX, it's $11 billion is in the SOX, SOXS ETF. That's semiconductors. If you look at the NUKZ, which is a wonderful, wonderful portfolio of independent power producers, uranium companies that are going to be SMR, small modular reactors. These are the companies that are going to be supporting the energy system for the next 20 years. Everyone's in the wrong trade. Everyone's in the semiconductors, and no one's in what we call the energy infrastructure. So the NUKZ valuation of that ETF is $240 million. Whereas there's 11 trillion in the what we call the SOX, which is the semiconductors ETF. Another important stat is NVIDIA. NVIDIA right today is worth about $3.5 trillion. That's $3,500 billion, right? That's in one company. Once again, passive index funds are driving that idiotic valuation, 24 times sales, right? For a company that's trading at $3.5 trillion. The top three holdings of the NUKZ, which are your Cameco's, your real independent power producers and uranium companies, are only worth 250 billion, right? So the point is, in order to get to the valuation of the dream of artificial intelligence, all these data centers, in order to reach the growth that's in some of these semiconductor companies, the uranium and independent power producers have to literally go up by, I think, 3 to 7x. In other words, there's no energy infrastructure. And then we get back to copper. You look at Peru, you look at Chile, and you look at Panama. 40% of global copper production is in three countries that have political pressure on production. If you look at global copper production in some of these hotspots, the growth is nowhere near what we need to rebuild the U.S. power grid. Everyone likes to talk about robotics, right? This is the most idiotic thing. I mean, people are just the idiocy of the media around some of these things is so insane. So you're gonna build 2 million robots, right? Okay, robots are gonna replace human beings. You know how much copper's in robots? Like literally, if you build 2 million robots, that's like almost a month of global copper production, right? Just on robots alone.
Right.
Not talking about the US power grid. We're not talking about the Ukraine rebuild, the Gaza rebuild, the LA rebuild. This is a crisis that's coming at us. I could see it as clear as day, and that no one cares because everybody's mind is on the market and passive investing and Nvidia, all these idiocy. It's just the biggest crisis coming at us for natural resources because what we've done for political reasons, if you just look at the top, we talked about this in the book. You look at the top copper mines that have come on the last decade relative to previous decades, or the top copper mines. It's just like turning around an aircraft carrier in the middle of the Atlantic. You just don't pop up a copper mine. It takes $10 billion and it might take 10 years. So we're in big trouble. And so forget about your artificial intelligence, forget about your robotics without a power grid and without enough copper to support it. So you want to be in a portfolio of companies that are going to be there for this incredible renaissance of commodities and hard assets. Meanwhile, everyone's long the 2010 to 20 portfolio. Everyone's long your NVIDIAs and your semiconductor. Everybody's in the wrong trade.
Larry, thank you so much for your time and for this absolutely fascinating conversation. I will link your wonderful book and the newsletter in the video description below. I actually look forward to reading your book. I will have to start soon because I think this is a fascinating topic and you truly discuss the changes in the world of finance and you sort of put that in the broader context. And I think this is what's so important these days because we don't hear anybody truly discuss this in this great detail. And then, of course, with your expertise in the subject, I think this is absolutely valuable. I learned so much from you today. I hope that you come back because I know that the audience has so many more questions for you, and I would love to see you here again.
My thank you so much, Lena, and I love your platform and I love what you built. What you built is inspiring to me. But let's think about mentors, younger people. You know what? Always ask. Be a great asker, right? And if you see a mentor out there, you want to build a relationship, there's no downside to asking, right? And a lot of really talented investors will take the time to be there for you. And that's how I did it. I'm not the smartest guy in the world, but I'm a very good asker. Very good asker.
Thank you so much, Larry.
Thank you, Lena.